Blood in the streets of Hong Kong's financial district today as panic-stricken traders watched their fortunes evaporate in real time. The unthinkable has happened. Hong Kong's Hang Seng Index, once the crown jewel of Asian markets, has collapsed in spectacular fashion, plunging a staggering 13.22% in a single day of frenzied trading. The financial devastation has sent shockwaves across the globe, triggering what may become the most consequential market meltdown since the 2008 financial crisis. This isn't just a market correction. This is financial carnage. The scenes from Hong Kong's trading floor tell the story. Veteran traders with thousand-yard stares, watching decades of wealth-building strategies crumble before their eyes. One trader described it as watching an economic hurricane make landfall. Another simply said, "We've never seen anything like this." And they haven't. Not since the 1997 Asian financial crisis has the Hang Seng suffered such a catastrophic single-day collapse. But today's crash may be far more ominous, as it comes amid mounting evidence that we are witnessing the opening salvos of a full-scale global trade war, one that threatens to unravel decades of economic integration and prosperity. The numbers are simply devastating. The Hang Seng closed at 19,928.30, erasing over $400 billion in market value in just 6.5 hours of trading. Every single one of the 83 stocks in the index closed in negative territory. A bloodbath with no survivors. The market's volatility index has surged to levels not seen since the early pandemic chaos of March 2022, signaling that investors expect more turbulence ahead. But Hong Kong is just the epicenter of a financial earthquake sending tremors across Asia and beyond. The technological beating heart of China's economy took the heaviest blow, with the Hang Seng Tech Index plummeting an almost incomprehensible 17.16%. Companies that represent China's technological future have seen their market values slashed overnight. Sunny Optical Technology, a key supplier for smartphone cameras, plunged 17.16%. BYD Electronic, part of China's EV manufacturing ecosystem, tumbled 16.85%. Lenovo Group, the world's largest PC manufacturer, cratered 16.58%. This isn't isolated to Hong Kong. Mainland China's Shanghai Composite dropped 7.34%, while the CSI 300 fell 7.05%. The contagion has spread rapidly across Asian markets. Japan's Nikkei 225 plummeted 7.8%, approaching bear market territory. South Korea's Kospi, home to global giants like Samsung and Hyundai, fell 5.6%. Australia's S&P ASX 200 lost 4.2%, and Taiwan's weighted index, critical to the global semiconductor supply chain, dropped a concerning 9.7%. The immediate trigger for this market catastrophe? The escalating trade war between the world's two largest economies has finally reached its breaking point. U.S. tariffs on Chinese goods have now climbed to an average of 54%, effectively cutting off major sectors of China's export-driven economy from their largest customer. Beijing has responded in kind, slapping a 34% tariff on all U.S. imports, a retaliatory move that threatens to strangle the flow of goods between the world's largest economies. But the contagion doesn't stop there. The U.S. has expanded its tariff regime to include Japan, now facing a 26% average tariff, Vietnam at a punishing 46%, and the European Union at 20%. This isn't just a U.S.-China dispute anymore. It's a fundamental restructuring of the global trading system that has underpinned decades of prosperity. The market reaction we're witnessing today suggests investors are finally coming to terms with a sobering reality. The era of globalization as we've known it is ending. What comes next remains frighteningly unclear. Inside China, authorities are scrambling to contain the damage. China's sovereign wealth fund, Central Huijin, has already intervened to stabilize local shares, increasing its holdings of major banks and state-owned enterprises in a defensive maneuver reminiscent of its actions during previous market crises. But analysts question whether even Beijing's deep pockets can stem this tide. This isn't just a matter of investor confidence, explains Wei Zhang, chief economist at Eastern Capital. We're seeing a fundamental reassessment of business models built on the assumption of relatively free trade between major economies. Those assumptions no longer hold. The repercussions are already spilling over to European markets, with the FTSE in London bracing for what analysts predict will be another dismal day of trading. Brussels isn't standing idle. The European Union is preparing its own retaliatory measures against U.S. tariffs, with a comprehensive package expected to be announced before month's end. These aren't just abstract numbers on a screen. Real economic pain is beginning to materialize. Fitch Ratings has downgraded China from A+ to A, forecasting GDP growth of just 4.4% in 2025, down from 5.0% in 2024. For an economy that had grown accustomed to growth rates above 6% for decades, this represents a significant contraction that will affect everything from employment to social stability. The mathematical reality is stark, says economist Raymond Wong. For every percentage point of growth China loses, approximately 7 to 8 million jobs are at risk. We're potentially looking at tens of millions of displaced workers across the Chinese economy if these trade tensions persist. The fallout is poised to hit U.S. markets when they open. Wall Street futures are flashing bright red, with Dow Jones futures down over 1,500 points and S&P 500 futures down more than 4%. The Nasdaq, heavily weighted toward technology companies with global supply chains, is likely to enter bear market territory defined as a 20% drop from recent highs. For average investors, today's market crash raises profound questions about retirement savings, college funds, and economic security. Pension funds around the world have significant exposure to Asian markets, meaning today's losses will eventually translate into reduced benefits for retirees who may have never heard of the Hang Seng Index. The human cost of today's market collapse extends beyond investors. Hong Kong's economy, already struggling to recover from the pandemic and political changes, now faces a crisis of confidence that could accelerate capital flight and brain drain. The territory's position as Asia's premier financial hub, a status it has jealously guarded for decades, now hangs in the balance. To understand the full implications of what we're witnessing, we need to step back and examine how we arrived at this precipice. The seeds of today's crisis were planted years ago, as tensions between the United States and China escalated from diplomatic spats to strategic competition to, now, open economic confrontation. The initial tariffs implemented in 2018 and 2019 were dismissed by many as negotiating tactics, temporary measures that would eventually give way to a grand bargain between Washington and Beijing. But that bargain never materialized. Instead, tariffs became normalized, expanding in both scope and scale as successive administrations in Washington came to view them not as aberrations, but as permanent features of a new economic landscape. What we're seeing is not a temporary trade dispute, explains Dr. Sarah Chen, professor of international economics. It's a structural decoupling of the world's two largest economies, with profound implications for global growth, inflation, and financial stability. The first victims of this decoupling have been multinational corporations with complex global supply chains. Companies that spent decades optimizing their operations for a world of relatively free trade now face a daunting reality. The business models that delivered shareholder value in the globalization era may be fundamentally broken in an age of economic nationalism. Take Apple, for example. Its intricate supply chain spans dozens of countries, with final assembly concentrated in China. If forced to restructure this network to avoid tariffs, the company faces billions in additional costs and potential disruptions to product launches. Similar stories are playing out across industries from automobiles to pharmaceuticals to consumer electronics. Companies built their supply chains for efficiency, not resilience, notes supply chain consultant David Miller. Now they're being forced to prioritize resilience over efficiency, and that transition will be neither cheap nor smooth. For consumers, the impact of today's market turmoil will eventually be felt at the checkout counter. The Peterson Institute for International Economics estimates that the expanded tariff regimes could add between $1,500 and $3,000 to annual household expenses for average American families. Similar effects will be felt in China, Europe, and other economies caught in the crossfire. The inflationary impact of these trade barriers comes at a particularly inopportune moment. Central banks around the world, including the Federal Reserve, had been making progress in their battle against inflation, creating space for potential interest rate cuts. That space may now be closing as tariffs push prices higher and complicate monetary policy decisions. Central bankers are being placed in an impossible position, says former Federal Reserve economist James Wilson. If they maintain higher rates to combat tariff-induced inflation, they risk deepening the economic damage. If they cut rates to cushion the blow to growth, they risk entrenching inflation. There are no good options. The market crash we're witnessing today also raises questions about financial stability. Years of low interest rates and quantitative easing have created pockets of leverage throughout the global financial system. As asset prices decline rapidly, those leverage points become potential sources of systemic risk. We don't yet know where the bodies are buried, warns financial risk analyst Sarah Johnson, employing a grim metaphor common in financial circles. Which hedge funds or family offices or regional banks have outsized exposure to Asian markets? Which counterparties would be affected if they fail? These questions will keep regulators up at night in the coming weeks. The echoes of previous financial crises are impossible to ignore. The 1997 Asian financial crisis began with seemingly contained problems in Thailand before spreading rapidly across the region. The 2008 global financial crisis started in the U.S. subprime mortgage market before engulfing the world's banking system. Today's crisis has begun in Hong Kong, but where it ends remains an open question. Political leaders face difficult choices in the days ahead. Do they double down on economic nationalism, arguing that short-term pain is necessary to achieve long-term strategic objectives? Or do they seek to de-escalate, recognizing that market chaos threatens broader economic and social stability? In Beijing, President Xi faces particular pressure. The Chinese Communist Party has staked much of its legitimacy on delivering economic prosperity. As growth slows and unemployment rises, social stability cannot be taken for granted. Already, there are reports of increased censorship on Chinese social media platforms as authorities seek to control the narrative around the market collapse. The Chinese leadership has always feared two things above all: social instability and capital flight, explains political risk consultant Li Wei. Today's market crash threatens to trigger both. They will respond forcefully, but whether that response addresses the underlying issues or merely treats the symptoms remains to be seen. In Washington, policymakers face their own dilemmas. The bipartisan consensus supporting a tougher stance on China has shown remarkable durability, but sustained market turmoil and economic pain could test that consensus. Businesses affected by tariffs and retaliatory measures are already lobbying intensely for relief. There's a reason trade wars fell out of fashion as a policy tool, notes historian Robert Jackson. They tend to produce widespread collateral damage without clearly achieving their strategic objectives. We're rediscovering that lesson in real time. For investors, the path forward is treacherous. Traditional safe havens like U.S. Treasury bonds have seen inflows as capital flees riskier assets, pushing yields lower despite inflation concerns. Gold has surged to new nominal highs as investors seek tangible stores of value. Cryptocurrency markets, often touted as uncorrelated assets, have proven vulnerable, with Bitcoin falling over 12% as leveraged positions are unwound. Diversification isn't working the way many investors expected, explains wealth manager Patricia Garcia. In a true crisis, correlations tend to converge as investors sell what they can, not what they want to. The coming days will be critical in determining whether today's market crash represents a painful but temporary adjustment or the beginning of a more prolonged crisis. Technical indicators suggest markets were overdue for a correction, but the speed and magnitude of today's decline point to something more concerning than a routine pullback. Market veterans are already drawing parallels to historical crashes, with some citing similarities to the 1987 Black Monday crash, which saw the Dow Jones Industrial Average fall 22.6% in a single day. Others see echoes of the 2000 dot-com bubble burst, which unfolded more gradually but ultimately wiped out trillions in market value. What makes today's situation particularly concerning is the backdrop, says market historian William Chen. In 1987, the underlying economy was fundamentally sound despite the market panic. Today, we're seeing market turmoil amid genuine economic restructuring driven by geopolitical forces. That's a more combustible mixture. For ordinary citizens watching the market drama unfold, the implications may seem abstract at first. But the connections between financial markets and the real economy are real and significant. Today's market crash will affect business investment decisions, hiring plans, and consumer confidence in the months ahead.